What is dollar cost averaging? Dollar cost averaging is a technique by investing a fixed amount of money into a security, such as a stock, through repeated intervals over a long period of time. For example, investing $10 a month for 2 years. Through continuous investing of money in intervals, you can see better results rather than dumping all of your money in a company at the same time. Taking the example from above, instead of investing $120 in January, you invest $10 every month of the year. So in other words, dollar cost averaging basically splits the total amount you're going to invest into smaller amounts over time. When the stock price rises, basically when it is very expensive, you would buy fewer shares of the stock. And when the stock price goes down, basically when it is very cheap, you would buy more shares of that stock.
What are the benefits of dollar cost averaging? As you buy more shares when the cost is low, you can reduce your average cost per share over time. To add on, it helps strip emotions out of investing. This is a huge benefit for beginners as emotions play a big risk factor in investing. It is also effective at reducing the risk of losing large amounts of money. Dollar cost averaging also helps if you don't have as much money to place into the stock market. Instead of saving up to pour your money into a stock, you can regularly add a fixed amount into the market so you can still benefit from market growth.
How to set up a dollar cost averaging plan? First, decide how much money you want to invest in a company. It's important to make sure you understand your financial capabilities when starting a dollar cost averaging investment. This way, you can be consistent and be effective with your strategy. Second, select a company that you can hold an investment on for a long period of time. You can evaluate a company's past earnings, future projections, and look to see if they have a consistent history of rising earnings. This will help you make a good decision about what long-term company you would like to invest in. Finally, as your designated intervals, weekly, monthly, or etc., invest in the money amount that you have chosen. It's important to notice that you can change how much you invest at your chosen interval at any given time.
Examples of dollar cost averaging. Forbes Advisor gives us an example on the benefit of dollar cost averaging. If you bought $1,200 worth of stocks at the price of $10 per share, you could get 120 shares. However, if you bought $100 worth of stocks a month for a year, which also adds up to $1,200, your average price per share will be $9.58 instead of $10, and you will own 125.24 shares by the end. That means by using dollar cost averaging, you will end up with 5.2 more shares in this example.
Who should use dollar cost averaging? You should use dollar cost averaging if you are a beginner in investing, you have small amounts to invest into the stock market, you don't want to do research on market timing, or you are unlikely to invest in down markets.
Who shouldn't use dollar cost averaging? You shouldn't use dollar cost averaging if you have lots of money to invest, investing in mutual funds that have higher initial investment minimums through a taxable brokerage account, don't mind researching and trying to time the market, or you're investing for a short term. Thank you for watching Animated Finance. Comment below on what you want us to do for our next video.